And gentlemen, please allow me to welcome you back to the Peterson Institute for International Economics. I'm the Institute's president, Adam Posen, and it's my pleasure to have you join us for the umpteenth semi-annual Global Economic Prospects meeting. We have now been doing this with one or two short interruptions for well over a decade, first under the leadership of the late Michael Musa, and over the last 5 years under the leadership of David Stockton. And we've been very fortunate to have great response. That we intentionally hold these roughly a week before the IMF World Economic Outlook comes out, not because we're afraid of differing from the consensus, but because we don't want to be seen as influenced by it. We are making our own independent assessments. And Dave and all our colleagues work together. In case you haven't figured it out, within these 4 floors of this building, we do not have 100 research analysts. We have 12 very good ones, but we do not have 100. We do not have a Cray supercomputer. The forecasting exercise is one done by judgment and some analytical thinking by our senior fellows. And again, David has coordinated that brilliantly for a few years now. I'm thrilled today to be having the Institute internal, in a sense, debut of the Honorable Karen Dynan. Karen, many of you know from her long and distinguished career at the Federal Reserve and on secondment to various government agencies as Vice President of Economic Studies across the street at Brookings, and most recently and most relevantly for today as Chief Economist and Assistant Secretary of the U.S. Treasury. She served with distinction in that post through much of the Obama administration, and she is now a non-resident senior fellow at the Institute and will be a mainstay, I'm delighted to say, of not only our work more broadly, but specifically of the global economic prospects process and product going forward. And Karen, I think, did you start professional life as an RA for Dave many years ago? David Stockton. So we sort of have scooped up the best of the Fed over the long term. I see Mike Prell, who trained Dave. We have the generations, just as we did with, on the international side, Ted Truman and others. And our third speaker today is Dr. Joseph Gagnon, who, of course, has now been a senior fellow at the Institute here for, I believe, 6 years, was one of my first hires. Or rather, Fred and I hired him when I was starting to have influence on the process. And Joe, of course, is a wonderful leading advocate and expert on U.S. policy concerning exchange rates. But as many of you know, he also served with distinction at the Fed and was one of the key staff architects of QE1 and has written on monetary policy issues. And we'll be speaking about that today as well. I'm not going to steal Dave and the team's thunder. I do want to point out that usually in this slot, I remind people of places where we got it right in the past with some of our forecasts, and hope you forget the times we got it wrong. That will be done in due course. I will just say that we are going today much more focused on the U.S. than we usually do. We usually have Dave give his presentation about the U.S. as well as the globe, and then we have a thematic or country-specific side presentation like Nicholas Lardy on China or Jacob Kierkegaard on Europe. Last time we were here, 6 months ago, we emphasized the politics and had to talk about the U.S., and this time policy uncertainty about the U.S., both monetary and fiscal, also regulatory, we feel dominates the forecast for the U.S. and the rest of the globe. So we hope you'll bear with us that despite being the Peterson Institute for International Economics, today thinking about international economics starts at home. So thank you very much. Greetings to all of you watching online, and let me turn it over to my colleague, David Stockton.
Thank you, Adam, and welcome everybody for being here. I guess my main message about the global economy is I think it's starting to gain some momentum. After a long period in which that was not in evidence, I think we're actually seeing some signs that the growth rate is picking up. I think I described September as sort of a driverless car in the slow lane. I think we've now actually shifted out into the middle lane. We're not in the passing lane just yet, but we're at a point where things are looking a little better. So indeed, I'm expecting global growth to pick up over the course of the next 2 years. It's being driven in part by improvements in the advanced economies, particularly the United States, where I see both the incoming data as suggesting a little more firmness and growth than we've had previously, as well as, I will discuss shortly, an anticipated fiscal stimulus that will provide a little bit of a boost to activity. In Europe, also signs that things are getting better. I think the Purchasing Managers Index in the Euro area reached a 6-year high recently. Yesterday's industrial production was a little disappointing, but for the most part, one's seeing improvements in labor markets, seeing some firmness in production. Outside of those two areas, I think for Japan, I'm just seeing more of the same. I don't really see any clear sign that either things are faltering or that we're breaking out of the growth rut that it's sort of been in. 1% or so is actually not so bad for the Japanese economy, but it's still pretty meager growth. And in terms of the United Kingdom, I'm less enthusiastic. I know many people have said that the performance of the UK economy since the Brexit vote was a sign that there's just more resilience in the UK economy. I kind of see this as temporary in the sense that the depreciation of the pound is in fact providing some support to growth right now. But the pound depreciated because there was an expectation that there's going to be some disruption and some pain associated with Brexit. And that pain still lies ahead of us. So I think while current readings look pretty good, and even then I'd say the consumer sector is looking a little bit stretched, I think we can look for slower growth. Not a cyclical downturn, not a recession, but some slowing in overall growth there. China, our story really hasn't changed very much and hasn't needed to change. I think we're still seeing some modest slowdown in the growth of GDP as the rebalancing continues. There are still the same risks associated with credit and associated with property markets in China, but the expectation is that those risks will not manifest themselves at least over the course of the next 2 years, and that the slowdown will be relatively modest. India looks like it's continuing to perform very well. Policy situation certainly looks much sounder than it has in relative to recent decades. Things look pretty good. And then, of course, some of the pickup in growth that we're expecting for the global economy as a whole is just the end of some incredibly painful episodes. Thinking about both Russia and Brazil, Russia's firmed up some, but obviously the collapse in output was really quite significant. The firmness of oil prices is now providing a little bit of lift there. And for Brazil, it's down, 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 and now basically going to be flat. So this is not even a forecast of a recovery. This is just a forecast of an end of a recession. So normally I hate to impose upon an audience by using some technical economic forecasting jargon, especially early in one of my presentations, but to understand the changes that we've made to this forecast, there's just no avoiding it this time around. So bearing that in mind, I've had to use that terminology more than once in my forecasting career, but this case really seems like it deserves the exclamation mark I've put on it. This is the exact slide that I showed in September during our global economic prospects to justify what I saw as the modal forecast using the outcome of the prediction markets. I was predicting divided government. We would have a Democratic president, probably a Democratic Senate, and almost certainly a Republican House. This obviously hasn't actually worked out. I might have even muttered a few non-technical phrases election evening as I saw this aspect of my forecast slipping away. But now, you might wonder, why bother coming? If we're going to make mistakes like this, why bother coming here and listening to us? But I want to let you know that the Peterson Institute was not asleep on the job. This is the second or third slide, exact replication of Adam Posen's presentation at our September meeting. And Adam concurred that the expectation that I put forward in terms of a modal forecast of a Democratic president and a divided Congress was not unreasonable, but he suggested perhaps we should explore more seriously the possibility of an alternative outcome. Given the uncertainties associated with Trump's polling and whether or not that was in fact an accurate reflection, one might need to take seriously the possibility that he could be elected. And if he was, the increasing correlation between congressional and presidential outcomes suggested that we could have a situation with a Trump presidency and a Republican-controlled Congress. And this is, in fact, what has transpired. And this is what we're working with currently in terms of adjusting the forecast. That's not all, of course, that's changed. There have been a lot of other changes that have occurred since our September forecast. And importantly, there's been a substantial increase in interest rates. With that, a strengthening of the dollar. There have been increases in asset prices, both in equity markets and house markets, and a firming of commodity prices. And indeed, much of this has transpired since the election. So clearly the election did have some effect on expectations for the economy. And this particular configuration certainly looks suggestive of one in which market participants see stronger aggregate demand now going forward. That's not all that's changed. In addition to Wall Street's changes, there's been Main Street changes as well. And you can see by the blue line an incredible surge in small business optimism, not surprising given that these surveys almost always show that small businesses complain most about regulation and taxes, two areas in which they are probably looking forward to some or anticipating some relief. The Purchasing Managers Index, which is sort of a cross between hard and soft data, has also shown a significant improvement in recent months, suggesting that they're actually either seeing or anticipating some further improvement. And I think actually surprising to me, a significant improvement in consumer confidence as well. So the entire background here, the environment in which the economy is currently operating, are certainly based on some expectations that the outlook has improved. And of course, important in that is a sense that fiscal policy is going to be more supportive. Now, obviously in doing a forecast, I got to write down some numbers. Here's what I've written down in terms of fiscal policy actions. I do think we are going to get some fiscal stimulus. I think the size of the package that I put together balances actually a real possibility that nothing happens. I think that certainly is well within the probability space, or that something more significant occurs. In the particular package that I fashioned, $100 billion in corporate tax cuts, not reform. I do not see reform, serious tax reform, as the most likely outcome at this point. I do think they will cut marginal tax rates for corporations. This $100 billion would fund something like a reduction from 35% to 27%. Could even go potentially lower if it was phased in. My colleague Jason Furman suggests that that's certainly a possibility. On the personal side, I don't think there will be any significant slashing of marginal tax rates for upper income individuals that was in the Trump plan originally and is in the House plan currently. I just think that's going to be too difficult. So I've added a little bit for some middle class tax cuts associated with child tax credits, and tuition assistance and a few other goodies that might be thrown that way. On spending, I think the risks are more to the upside than to the downside. And indeed, as you know, President Trump has asked for $54 billion increase in defense spending, offset completely by $54 billion in reductions in non-defense discretionary spending. I just don't see that happening. I think to get an increase in defense spending, they're going to have to give and allow some increase in non-defense spending, in essence, to politically grease the wheels to get that done. And on infrastructure, I don't know what's going to happen. And obviously, there's a lot of uncertainty about currently what people are saying. I would assume that there will be some package. They won't just completely walk away from it. This is like $200 billion over 10 years, not the $1 trillion that the administration is currently talking about. So it's a modest package of about 1% of GDP. When I first was forecasting this, I was pushing back on what I thought were market expectations of package fiscal stimulus that was both too large and too quick. So my package, relative to sort of the initial expectations, was both smaller and more delayed, because I just don't think anything's going to happen this year in terms of actual fiscal stimulus, and it will only start phasing in 2018. I think market expectations have been shifting in my direction, maybe even have overshot perhaps on the other side, but certainly going that direction. The difficulty is that this fiscal stimulus isn't all going to be net additional GDP. We do have a Federal Reserve that is in the process of normalizing interest rates, and as for those of you who have been attending these meetings will recall, I've been quite skeptical of the Fed's expectations of their raising rates as rapidly as they have over the last 2 years, but actually now I think the Fed's expectations are reasonable, and that they're likely to act on those expectations, and that we'll see an additional 2 interest rate hikes this year, followed by 3 next year and 3 the following year, but it's a gradual taking up of interest rates and the beginning of the normalization of the Fed's balance sheet. I think we are likely to get, the Fed has obviously been on an active discussion of exactly how to do this. I think they'll make an announcement this summer or this fall about what their plans for the balance sheet are going to be, and then implement them by late next year. So it isn't quite like whatever fiscal stimulus comes along is not going to be facing the constraint of a Fed that is in a tightening mode. I do think the Fed will not act preemptively in terms of tightening monetary policy in anticipation of looser fiscal policy. And that, I think, puts us in a situation where it's quite likely that we are facing some overshoot. So here's my forecast on a Q4 over Q4 basis for the U.S. I've got growth. I think growth potential currently is about 1 3/4. So these 2% plus figures that I'm showing for growth are enough to actually continue to take up slack in the labor market, reduce the unemployment rate from its current 4.5 to 4 3/4 level to about 4 1/4 by the end of the forecast horizon. So we have output overshooting potential. And at the same time, we're going to have inflation move above the Fed's 2% target, but just a little bit, by forecast at least, to 2.1%. So why is this overshoot so limited, you might ask, given the fact that the Fed's still sitting with a funds rate below 1%? There are a few reasons for this. One is the overshoot could have been even larger, but for the fact that the demand is being shifted away from U.S. producers and toward foreign producers. So this is both history and forecast that decomposes the growth of GDP into private final demands, government demand, inventories, and net exports. So what you see, the growth that we've had on private domestic demand, which in absolute terms is about 2.5 to 2 3/4%, actually is pretty strong growth in demand. And that is certainly consistent with the fact that, at least from a domestic perspective, financial conditions are relatively accommodative. Some of that's been offset by a little bit of a trimming of inventories. But I think the more important factor is the rise in the dollar in 2014 and 2015 means that we're losing about 0.5 percentage point of growth from net exports, which really means what's happening is the rise in the dollar is shifting global demand away from U.S. producers and towards foreign producers. So that's sort of limited, in some sense, the amount of overshoot we're getting on growth. That's showing through. I think that's certainly the weakness of the euro and the weakness of the yen, the strength of the dollar, has helped support and is at least one factor behind the firming of activity that we're seeing especially in Europe, and the improvement in the unemployment rate that's transpired there. But the deeper message here is that the US and Europe are still in very different cyclical positions. It is still the case the US is very close to full employment. Europe is still very far away. That global divergence is even more apparent on the inflation side, where you can see that inflation for the US moving back towards 2%, but in core inflation measures for the Euro area and for Japan are still way far away from objectives. So we're going to have a situation where the mismatch here, the asynchronous aspect of the cycle, is going to be in play for a long time, and that suggests that the dollar strength that we're currently observing is not going to dissipate anytime soon. This is going to be an ongoing feature of the US and global economic environment for quite some time. Now, the overshoot is also being limited by some domestic factors as well. So you can see on the left-hand side here, don't worry about last month's employment report, 98,000. We still averaged 178,000 per month in the first quarter of this year. Initial claims remain low, employment growth remains strong. What you can see here is we're growing well above the 80 to 100,000 jobs we need per month just to stabilize the unemployment rate in sort of normal circumstances. What has bailed us out, or certainly has helped, is that the strength of the labor market has resulted in some flattening out of labor force participation rate. It has allowed that fast growth in employment to occur without a rapid reduction in the unemployment rate. And again, for those of you who have been here more than once, we've certainly been talking about this for a time now. Those of us felt that there was at least a significant benefit from the Fed allowing the economy to grow more rapidly, to at least to push the envelope on this to see whether or not, in fact, there was more slack. And I think that, in fact, looks to be the case. As of yet, I think it hasn't shown through strongly, this tightening of the labor markets also hasn't shown through strongly into labor compensation. I've shown three measures here. One is a measure put together by the Atlanta Fed designed to capture the wages of people who are not changing jobs, and it's a median wage measure. It shows that there's been some firming. Average hourly earnings, which comes out each month with the employment situation, also has picked up some. But probably our single best measure of labor compensation, and the one that the Fed follows most closely, is the employment cost index. And if you squint, you can see a little bit of pickup there, but really something from a little bit below 2% to something that is a bit more along the lines of 2.25%. And I'm expecting some very gradual further acceleration in wages going forward. Why so gradual? I mean, we have the unemployment rate in my forecast falling to 4.25%. Well, I think the reason is the evidence suggests that the Phillips curve in the United States is just a lot flatter now than it used to be. Inflation is much less sensitive to the state of resource utilization than was the case in the past. And you can see this by just taking a look at a Phillips curve traced out in the 1961 to 84 period, sort of having the kind of slope that most of us grew up with in the textbooks. Since then, there's a little bit of upward slope, but man, not much. So I think this overshoot is not likely to result in a rapid acceleration. Indeed, it's one of the reasons why, in my forecast, it overshoots the 2% target, but just by a little bit. The one thing to watch in all of this, of course, will be what transpires with inflation expectations. You can't exploit that Phillips curve forever. That is, you cannot continue to run an overly hot economy without it eventually showing through to some acceleration of inflation. And when that shows through into inflation expectations, the cost of reversing that get much higher. So I think certainly I would anticipate the Fed is going to be monitoring this carefully, and I would suggest everyone else do the same, because this is an area to find out whether or not the very low unemployment rates that they've already transpired, but that I'm also continuing to expect will in fact result in higher inflation. So let me just go to some of the risks to the outlook. Well, one risk is a growing perception of governmental incompetence. You might ask, can there be any growth in the expectations of incompetence given what we've been seeing? I think the answer is yes. There still is a risk as we come up on budget negotiations, as we come back to the debt limit. I think trade I would put in this category as well. Plenty of opportunities. And I'm thinking about this more broadly, not necessarily just a triggering event, but a sense that, in fact, the United States is not tackling seriously its problems. And then the improvement in financial conditions, the improvement in confidence, the things that sort of been undergirding some of the greater optimism about the U.S. economy could come out very quickly and in an adverse way that might make it more risky. Another area of risk is Federal Reserve. Obviously, the Fed could make plain old Fed policy error, tightening up too quickly in an economy that's still vulnerable. But there's going to be a significant change of leadership at the Federal Reserve a year from now. And that certainly opens up opportunities for both an untested team to make mistakes, for financial markets to either test or bail on the Fed in some way that could lead to a more rapid increase in interest rates in some kind of a shock. And finally, there are upside risks. I mean, in the last few years in doing this presentation, I always felt like, okay, I had to put in something for an upside risk. They couldn't all be to the downside, but it always felt a little more half-hearted. I do think we could be looking at a situation where there is a more synchronous upturn in global activity, trade, inflation. While the U.S. is close to its potential, there's still lots of slack elsewhere in the world. And with the appropriate policies reinforcing that slack could come out more quickly, and we could be looking at a more favorable economic outlook than I or the current consensus are expecting. So I'm going to stop there.
Great, thanks. It's great to be here. Thanks to Adam for that very nice introduction. It is true that Dave Stockton was my first boss back when I knew almost nothing about anything. So I'd like to think that I wouldn't be here where I am today if it not for Dave's patience and what he taught me. Anyway, I'm going to talk a little further about prospects for U.S. fiscal policy and regulatory policy to boost growth. So I'm going to start kind of jumping off the slide that Dave had on what he said was improving confidence. And I've thrown a few more measures up here. Two notable things I want to point out. And first is that it's not a story about gradually improving confidence. It was really a jump in confidence late last year. And the second thing I want to point out is that there was really a big component of it that was about expectations. So on the left, I have consumer expectations from the Conference Board. That's a series that speaks to what people perceive is going to happen in the terms of business conditions, employment conditions, and their own income. I also, in orange, have the Business Roundtable CEO Economic Outlook. That jumped on higher expectations for sales and hiring. I've stuck the stock market on the right. It has moved up notably. In terms of what explains that up movement, we know it's not a story about lower discount rates because we know interest rates are higher. So it is consistent with the view that people now expect economic growth to be higher. Okay, so the other thing I want to point out is that even forecasters, that would be our colleagues in the dismal science, seem cheerier for a change. And I know this is a median, the median forecast for GDP growth over the next 10 years from the Survey of Professional Forecasters. And I know this isn't the kind of up spike we saw in the consumer and business surveys, but yet I find it striking because we had been on kind of this long kind of down march where people were downgrading forecasts as they were getting their mind around kind of a slower productivity growth world. And I think certainly 6 months ago, one would have expected perhaps more, a further downward adjustment, or maybe staying at the kind of lower level we had arrived at. But instead, we got this uptick. And this is a question that's asked every February. So that's the timing of this, that the uptick occurred just a couple of months ago. So without further ado, what explains all this? Well, I'm sure this is not going to come as a surprise to everyone, but I think a very plausible explanation is that the policies of the new administration are expected to enhance the performance of the U.S. economy. I've thrown one piece of soft evidence up here, which is this is a chart from the Michigan Survey of Consumers. They have a question that explicitly asks, how do you perceive government policy? Is the government doing a good job with economic policy? And what you can see there is that in fact, that indicator jumped right in November and has stayed quite high. Just coming back to Dave's point on financial markets, whether we should count that as evidence supporting this point, I agree with his assessment that if you look category by category within, say, the stock market, it's not the case. I mean, early on we had seen the categories that look like it would benefit from specific policies outperform. That's no longer the case, but the stock market is reacting to something. So this is what I think the most plausible explanation is. To jump to my own punchline, I think the optimism seems overblown. And I'm going to make the case that it's overblown both because we're not going to see the kinds of changes in fiscal and regulatory policy that people expect, and also because the changes we do get will be kind of less potent in terms of their effects on the economy than what people think they will be. Okay, so just to lay a little groundwork to set up my comments on policy, I just want to talk a little bit about what I see as the growth challenge. So growth has been tepid by historical standards over the last 5 years. Real GDP growth has averaged a little more than 2%. So that's more than a full percentage point below the averages we saw in the last 25 years of the 1900s. And there's been a bunch of discussion about this in both kind of commentary and research. And the conclusion that's been drawn is that really you can explain this slowdown in growth through supply-side factors, and most notably a slowdown in the growth rate of the labor force. So the factors there include the fact that women are no longer surging into the workforce, and also that baby boomers have started to retire. So that's the main factor that explains the slowdown, but of course productivity growth has been slow as well. And even though most forecasters expect some pickup from the very slow rates that we've seen over the last few years, they see productivity growth picking up to kind of the lower end of the historical range. So in terms of what you can do about it with policy, demand stimulus, that can give you a little bit of boost, but the boost you get is going to be really something you get in the near term, and it's going to be limited. And that's because the Fed is going to react. We're at almost full employment now, so anything that pushes growth much higher than potential will get a Fed reaction. So really, to change GDP growth, what you need to do, if you want a sustained higher pace of growth, you need to boost those supply-side determinants of output. So you need to boost labor force participation. You need to do things that boost productivity growth. Okay, so let me talk a little bit about policy now. I will start with tax reform, since that's what's in the legislative spotlight right now. So my main point here is tax reform. It's very hard. So there is indeed broad kind of bipartisan interest in tax reform, and that's been true for a while. But the point I want to make is that widespread support for tax reform in principle does not imply that any specific plan for tax reform is going to garner sufficient support to be enacted. And basically, the issue is that although I think there is one area where kind of the focus is consolidating, and that's on the corporate or business side, There are just so many unanswered questions, and these questions involve hard trade-offs. So probably the biggest one is whether we're talking about revenue neutral tax reform or deficit increasing tax reform. The revenue neutral strategy has a parliamentary advantage. The Republicans can do it with just 50 votes in the Senate, so they can essentially do it by themselves. The problem with revenue neutral tax reform is you're going to get winners and you're going to get losers, and those losers are going to fight very hard against any revenue neutral proposal that's hurting them. So you could go to deficit increasing tax reform, but then you can't do it through reconciliation, which is the process that involves only 50 votes in the Senate, or the votes of only 50 senators. So you'd need to bring some Democrats on board to get the 60 votes that you need in the Senate, and you're also going to lose some Republicans who don't like the idea of increasing deficits. So that's probably the biggest question. But also you have a question about distribution neutral or favoring high income taxpayers. The plans that we've seen certainly over the past year have very much favored high income taxpayers. That is not going to go over well with some voters, and particularly if you need to attract Democrats to support the plan, that's going to be a big challenge. And then the last really important question here is, how do you want to design it? Do you shift to a consumption tax? And here I'm talking about the border adjustment tax that has received so much attention, or should you stick with the current approach? And I would say with the border adjustment tax, one of the huge challenges is that, I mean, we know politically it's controversial, but experts don't agree. And here I will cite Peterson, because Peterson has really become kind of the go-to place that's done like just tons of wonderful analysis on here. But there are some big uncertainties related to whether the exchange rate adjusts so as to offset the impact of the border adjustment tax on imports and exports. If it does, that's good news for imports and exports. It's bad news in terms of lowering the value of U.S. assets held overseas, and it can cause international financial disruptions. But if you don't get the full adjustment, then you're going to see importers face cost pressures, which is going to hurt them, and also possibly pass those cost pressures along to consumers. Okay, so in terms of the effects on the economy of tax reform, there's always a lot of speculation that we can do tax reform and it'll pay for itself because you get these big behavioral responses in the economy that generate a lot of extra GDP. We have one nice data point on this, which is that Congressman Camp a couple of years ago released a tax reform plan that was scored by the nonpartisan Joint Tax Committee on the Hill. And this plan was designed to be revenue neutral and distributional neutral. And what I'm showing you here is kind of the range of estimates that came out of the Joint Tax Committee's models. These are effects on the level of GDP over the next 10 years. If you take the midpoint of those effects, what you see is a tiny boost to GDP growth. It's less than 0.1 percentage point per year for annual growth. So it just shows the kind of challenge of really trying to stimulate the economy through tax reform. I mean, of course, you can relax the assumptions of revenue neutrality and distributional neutrality, but then you're back to some of the challenges that I was talking about with the last slide in terms of the obstacles to getting it passed. Okay, so I think all told, I think that the odds of getting tax reform, very limited. So if it fails, I do think that some fallback change in the tax code is likely. And a couple of things here. So first of all, one thing that gets talked about a lot is the tax break for US multinational firms that repatriate funds. So a lot of talk about this. I think where the talk is problematic is the idea that this will somehow cause a lot of investment in this country that will boost growth. The problem here is that a lot of the firms that would return funds to this country, they're already sitting on a lot of cash that they're not using for investment. So it's very unlikely to boost growth significantly. The other thing that people are talking about is just a plain old tax cut. And This is what, of course, Dave is building into his forecast, and I do agree that this is a very likely I agree it's the most likely outcome in terms of taxes. It's doable through, again, this reconciliation process that would just require the support of 50 senators, so the Republicans could do it by themselves. You could also, if you make it, but the key there is you need to have the tax cuts sunset within 10 years. You could structure the plan to win over some Democrats by, for example, having features that would be more advantageous to kind of the middle class. Here, I think, if you want to tie it to growth, limited near-term effects. And that's because I think the main channel through which it would affect growth would be through demand stimulus. And as I said before, that's not a recipe for sustained long-term growth. In terms of long-term growth, a tax cut could be neutral or it could be negative because you are increasing the deficit. Okay, so that is taxes. Let me turn now to appropriations. Here, the first order of business is just finishing appropriations for the current fiscal year. Right now, the government is operating under a continuing resolution that will expire at the end of April, hence the worries about government shutdowns. The government will shut down on April 29th if Congress does not do something about it. They're going to need some support from Democrats to pass appropriations bills because they do need 60 votes in the Senate. So to do that, the Republicans are going to need to compromise, to soften the austerity of the funding that they eventually adopt. And I think it's likely they will do it because they're going to own it. They're going to be to blame if the government does shut down. So I think they're likely to work hard to avoid it. So once that's done, then we get on to appropriations for the next fiscal year, 2018. The biggest thing that's happened here is that the Trump administration has released what's called its skinny budget, released it in mid-March. And basically the skinny budget is an outline of the administration's plans for discretionary spending. So it does not take up mandatory spending. So that would be spending associated with the big entitlement programs. That's a whole different conversation. So we're going to limit this to discretionary spending. And you can see on the left, the chart shows you how in orange, that bar shows you what their proposal is for 2018, how it compares with actual spending in 2017. You can see there's a decline of $14 billion. So that would be contractionary in the near term. The budget also includes a $54 billion shift from non-defense spending to defense spending. That's just the spending under the caps. There's actually an even larger decline in non-defense spending because there's a little bit of spending that's also cut outside of the caps. But if you want to take that to kind of implications for long-term economic growth, here is a chart that shows you non-defense discretionary spending historically. So this is non-defense discretionary spending relative to GDP. And that's the history in blue, and the orange dot shows you approximately where the Trump budget, their proposal for 2018 would leave you. You can see it's well below the historical range. This is the category of spending that includes those investments that would be expected to stimulate growth. So it includes infrastructure, it includes many important education and training programs, it includes money for research and development. So this sort of plan hardly seems like a recipe for kind of pro-growth economic policy to me. Anyway, in terms of what actually is going to happen, presidents' budgets, they don't usually get enacted in full. What they are is a signaling device in terms of what the president would like to happen, and it can lay some groundwork for what Congress ultimately does. And here I think the most likely outcome is that we will see some increase in appropriations in 2018. We won't see that cut in total discretionary spending. And the reason here is that people, they generally support increased defense spending. So defense spending is much more likely to rise, but non-defense spending, it's not likely to fall. People support, or many people support, cutting non-defense spending in the abstract. But when it comes down to it and people start talking about cuts for the State Department or cuts for the NIH or cuts to the Energy Department programs that send grants out to states, they're not going to support that. So I think the most likely scenario is that we'll see an increase in defense spending. We'll probably see non-defense spending staying about where it is, which would leave appropriations rising on net. I think the most likely outcome is they won't rise enough to avoid a mild contractionary effect. You need a $50 billion rise. I'm almost done. You need a $50 billion rise to be neutral for GDP. That's spending. I have just a slide on regulatory relief. Here, I think it could be a plus for growth. I don't think it would be a big plus for growth. I should say the evidence on how big an effect on growth, it's very mixed. There really is nothing that speaks to the magnitude of these effects. But I think the bigger issue for regulatory relief is that there are big obstacles. So changing most regulations involves a long and complicated process. You need to produce as much analysis to undo a regulation that's final as went into the initial regulation. That can involve years. And we'll need to grapple with the societal trade-offs associated with undoing regulations. My last slide is just a grab bag in terms of other policies that people are talking about in the context of economic growth. Here, infrastructure, a lot of talk about it, totally unclear where we're going. Totally unclear how much money we're talking about it. I think Dave signaled that. Also unclear what form it's going to take. As a general principle, if it comes in the form of tax cuts, if you are looking to get additional infrastructure investment, it's not going to be as powerful simply because you'll see some projects that are taking advantage of the tax credit that would have been done anyway in the absence, just a switch in the form of funding. Healthcare, if there are changes, they're not going to have macro significance. The story people tell is that we'll increase labor supply, but CBO has showed us that those effects aren't very important for GDP. Immigration, the administration's stated goals in terms of immigration, they would lower growth. They would exacerbate the problem that we're having in terms of the labor force shrinking. And then just lastly, on the debt ceiling, I think the most likely outcome is a lot of noise over that debate, but default is unlikely. So just to wrap up, I agree with Dave that the most likely course for the economy is that we'll see continued solid growth. But I don't think we're going to get the boost from policy that that many people expect. It's certainly not a boost that is going to add percentage points to growth or even many tenths of percentage points to growth. And that's it.
Thanks to everyone for coming today. I'll be batting cleanup, but not that Dave and Karen need any cleaning up. I'm going to talk about monetary policy and exchange rates, focusing on the U.S., but in an international context. So let's hope this works here. To start out with, I'd like to point out that this tightening cycle we've had now for 16 months is a very slow one in historical perspective. What I'm graphing here is the current tightening cycle and the last 4. What the lines show is the cumulative change in the federal funds rate after the beginning of the tightening. So from the month before the tightening starts, you subtract that off, and that's the cumulative tightening is the amount over that. The thick black line is the current cycle, which started in December 2015, and so we're comparing it to a base of November 2015. As of now, we have about 0.75% of interest rate increases so far. But if you look at the previous cycles, for 3 of them anyway, at this point, we would have had a lot more. We would have had 3 whole percentage points of tightening in those cycles. Now, the one cycle that is a little different is, it's I guess supposed to be dark red. And that was the cycle that began in April of 1987. And what happened there was in October of 87, there was a large stock market crash, which caught us by surprise. The Fed reversed course, as you can see in the dark red line, after 6 months, and loosened for a while because we were worried there would be a recession. That was actually the month after I started to work at the Federal Reserve out of graduate school. Anyway, well, it turned out that there wasn't a recession, and it was sort of a false alarm. And then the Fed actually got a bit behind the curve and had to catch up. And we even had a little bit of inflation going above the target then in that process. Now, I guess the one point would be, are we at risk of falling behind the curve again now? And I think that's possibly a risk, but I don't think it's particularly likely, and I think there's an equal risk that we could be, if anything, going too fast. One reason for the slow increases, as Dave talked about, is that the dollar has been very strong since late 2014, and this has held back net exports. This has slowed down the growth of real GDP, and that's sort of keeping the Fed. That's one reason, and I'll get to some more factors. I think probably more important is that we're not really heading up as high in the end as we used to. I think there's a new normal of lower interest rates. This can be attributed to the broad category of secular stagnation, which has been talked about lately, particularly promoted by Larry Summers. But underneath that, different people may have different views, but there are just some facts, just some actual features of the data that would each individually point towards lower interest rates. These include a low population growth, especially growth of working age population, and as Karen said, in the US, less entry of women into the labor force. So for all these reasons, less need to build factories and buy plant and equipment for workers, and also less household formation, less need to build houses. Retirement saving is up. As people approach retirement, they save more, and even in the early years of retirement, they save quite surprisingly a lot. It's only later into retirement they start to dis-save. Productivity growth, as we've heard, has been lower than historical averages. That keeps down demand for investment. A global saving glut, which Ben Bernanke first talked about, and foreign exchange policies, which I've argued is a big factor behind the global saving glut. Foreign governments are actively saving money in the advanced economies, holding down interest rates in those advanced economies. This was very important for most of the past 15 years, but as I'll come back to at the end, is actually less important lately, but could come back and form as part of the baseline. Finally, regulatory changes that increase demand for safe assets may be contributing, and federal funds rate is a rate of return on a safe asset, so that keeps it low. This slide gives you a sense of how much these changes would be expected over the long run. So what we see here is forecasts of individual participants in the Federal Open Market Committee, that's the Federal Reserve's policy-making board, their expectations of the long-run federal funds rate. And on the left, you see for 5 years ago, the red dots show the individual forecasts at that time. The median value of these forecasts was 4.25%. As you go to last month, March 2017, you see a dramatic decline. The median value is 3%. There's actually more people below that than above that. And I think it's arguable that we may not have quite seen the end of this shift. So I don't know. It's hard to say exactly how much further it might have to run, but it could have another 25, 50 basis points because it has been falling for a while now. And hasn't steadied out yet. We're not sure where the bottom is. People are reassessing their views. That's already a 1.25 percentage point drop in the long-run funds rate. That means we have, and possibly a bit more to come, that means that we don't have to raise rates as fast because we're not going to go as high up. And this focuses on the US, but I think there's every reason to expect that it's true in many other countries around the world, especially in Europe, in Japan. They're clearly behind us in tightening. They haven't even started tightening in Europe and Japan. But when they do, they're also probably going to be going slow because they will be going to a lower long-run level. Okay. Now, turning to the exchange rate, and as I said, the exchange rate is probably one reason also for the slowdown in tightening. I think one risk to the dollar, upward risk to the dollar, may be that market participants haven't fully priced in the fiscal tightening we might get. Immediately after the election, the dollar went up 4 percentage points, but it's given back half or more of those gains. When I looked at surveys of forecasters' projections for the U.S. fiscal deficit, what I saw was really a bimodal pattern where many forecasters had no change forecast in the next year or two, and then many had something like what Dave gave us as a forecast. Very few were above that much, but if you take sort of the average of those two groups, that may be what markets are pricing in, which is less than we forecast. Now, if, in fact, as markets come to understand that Dave's going to be right, then perhaps there'll be some more upward pressure on bond yields and the dollar. It's hard to say how much, but one thing that would go along with that is that the Fed would presumably start to accelerate their tightening if that were to happen. But the key is they won't do that in advance. I mean, they will wait to see what the President and Congress agree on and actually pass before they would accelerate. So this is a chart of the real or inflation-adjusted trade-weighted dollar. It's a broad index that the Federal Reserve creates. It's against many, many countries, both advanced and developing countries, not just a few major currencies. We have over 40 years of history on the left, and what you see is two big peaks in 1985 and then again in 2002. And with a lag after those peaks, we had very large trade deficits. On the other hand, after the low points, that was when trade was close to balance, as seen on a sustainable path. Well, we were roughly there a few years ago, but as you can see, we are starting on an upward path again, and on the right, I've expanded that last 3 years to see a bit more detail. The vertical line on the right is the election, and so the dollar went up about 4% after the election, and it's given back about 2% lately, and that's where we are. I think the question is, if fiscal expansion is as big as Dave expects, I would expect at least a return to that peak, possibly more, and then if it's even bigger, then perhaps higher. It's also possible that markets it depends really a lot on optimism about the dollar and the U.S. economy. So as you can see, historically, we aren't at a previous peak, so it wouldn't be impossible to see an even higher level of the dollar. But one implication of all that is that it probably would lead to a significant widening of the trade deficit. So I will finish with a brief discussion of foreign exchange policies around the world. As you know, I've done a lot of, or some of you may know, I've worked on the effect of foreign exchange intervention on trade imbalances, and this was a big deal for most of the past 15 years. But in 2015 and 2016, these foreign exchange interventions on balance have dropped to near zero. And what we have is a few countries that do remain significant net buyers of foreign exchange, led by Switzerland, have become, while others have become net sellers, led by China. And in particular, China for 2 years now has been the largest net seller of foreign exchange reserves. They're trying to hold their currency up, keep it from depreciating. So this is the opposite of currency manipulation as we have defined it, which is trying to hold your current account too high. They're actually trying to prevent it from being too high, and it's currently at a reasonable level. So it seems to me when Treasury puts out its foreign exchange report, right now it would be hard to label China as a manipulator, in my view. What is driving this big change? Well, there was a lot of investment flows into emerging markets after the Great Recession. That seemed to be an attractive place to go. They were doing relatively well. Maybe markets overdid it. They got a little scared. Some of these investments may have been risky. And so that sort of flow reversed a bit. And then the US became the favored haven over Europe and Japan because the US is doing relatively better economically. So all these things sort of have combined to put the pressure on the dollar that we saw. Now, as I said, the dollar is still below its previous peaks, but even at the current level of the dollar, I think the trade deficit is going to continue to rise. We haven't seen it to date because the fall in oil prices has reduced the nominal value of imports. But as Dave showed, in terms of real net exports, it's been showing up already for several years in slowing the economy down. Now that oil prices steady out, it's going to show up, not only continue to be in the real side, but also on the nominal side, so that the trade deficit will start to grow. And of course, if the dollar goes higher, then that gets even larger. I'll stop there.
Thank you, Joe. Thank you, Karen. Thank you, Dave. If I can ask you to come up to the panel. We're going to have on-the-record questions and answers with our distinguished colleagues. But while they get settled, since Dave was kind enough to point out that my being an outlier was somehow accurate last time, I'd like to spend 2 minutes just telling you why I'm in a little different place than Dave and Karen on fiscal policy. Just as an alternative scenario, I would encourage you to think about a much higher upside risk of larger fiscal spending unfinanced. People keep talking, as Karen and others do, quite reasonably, if you believe politicians, that deficit spending and fiscal discipline matter to one wing of the Republican Party. This morning, the OMB director, Mick Mulvaney, who was considered one of the deans of the deficit hawk wing of the Republican Party, said on CNBC, and I quote, "I'm really not interested in how tax reform handles the deficit." I think it's important to have a bit of international perspective on U.S. and historical perspective on U.S. fiscal policy. We're not Argentina or Greece, but if you look at U.S. fiscal history over the last 40 years, every time the Congress passes a self-regulating limit on deficits or revenues, out of excessive revenue spending, they violate it or withdraw it within 3 years. Again, this isn't quite Greece, but the idea that Congress has successfully imposed fiscal discipline on itself in any binding way since the mid-1970s is simply false. And so it's worth, sort of putting on one's goggles that if we walk around in markets, at the IMF, at the World Bank, in this building, and sort of hold forth on the fiscal laxity of others and sort of shake our head at Italy or Japan or whoever, others could shake their head at us. And not to be too cute about this, I think that's an actually important perspective. I remember back getting into a fight with the first Bush administration official who was patting himself on the back very greatly that, oh, we did deficit reduction. It was so hard, it was so difficult. And I pointed out to him that when the first Bush administration did deficit reduction, it was simultaneous with everybody else in the OECD doing deficit reduction. It actually wasn't that special. It happened to be what was going on at the time. And he's like, no, we did all these great things. It's like, well, okay. A little international perspective on the US, I think, is important. And that leads me to think that unfunded large fiscal deficits by large tax cuts that will get, Karen, I think, is absolutely right to sort of think of things in terms of what's the effective coalition, that you can have lip service and not have an effective coalition. I think her analysis fits perfectly what happened with healthcare, that there was no set that would commonly agree on healthcare, whereas I do think there is a set of voters who will commonly agree, oh, unfunded tax cuts, that's fine. So then there's a whole cascade of other implications through the discussion that Joe took if you buy that. Again, this isn't to argue with my colleagues. My colleagues are probably right. But just in the spirit of Peterson and in the spirit of forecasting, I would just urge you to at least think about the upside risks on U.S. fiscal policy. Anyway, let me stop there. As is usual, we have a traveling mic up front in Jessica's hand. We have a standing mic at the back. Please identify yourself when you come out to ask a question. And if you wish to direct it to a particular member of the panel, please do so. Please, sir.
Hello, I'm Gonzalo Garcia from the Embassy of Spain. I would like to ask Karen about the fiscal reform and the role that the Congressional Budget Office could have, and particularly dynamic scoring in trying to, reconcile those trade-offs, particularly the neutrality trade-off, because there seems to be a lot of hope in some of the people that are supporting fundamental tax reform on that issue. Thank you.
The Congressional Budget Office, so I should say, when it comes to a tax plan, the responsibilities for scoring purely a tax plan lie with the Joint Tax Committee, which, like the Congressional Budget Office, is a nonpartisan part of Congress. But the CBO does, they're supportive of dynamic scoring, and they have kind of tried to incorporate dynamic effects into their analysis. You can find some of those analyses on their website. For example, they've talked about kind of the dynamic response to healthcare reform and how the implied changes in GDP would then change how you score the plan. So I think generally this CBO, highly respected organization, does have a role to play. I'm happy to see that they are very open to the idea. I think the biggest challenges are that the literature that you're building off of, or the evidence that you're building off of to dynamically score various pieces of legislation is thin in some areas.
Thank you.
And can I just add on that score, both the Joint Committee on Taxation and the CBO, I think, do very good, reasonable jobs of dynamic scoring. Their dynamic scoring isn't going to save the sort of deficit, produce anything close to growth effects that create deficit neutrality. So the hope of some that dynamic scoring will rescue a more aggressive cut in taxes isn't going to happen through the Joint Committee of Taxation or the CBO. And now they might appeal to other outside models, and there are some in this town that produce more significant offsets, but the official dynamic scores aren't going to be the savior of that plan.
Yep. Another question or comment, please? Wow. All right, so let me push the panelists a bit for a minute. Oh, there is. Oh, good. Sir.
Ted Truman from the Peterson Institute. I was holding back because we're supposed to be holding back. But on the other hand,
you're not supposed to hold back. You're merely supposed to wait for our guests to get a chance. That's all. And you did.
Now I'm in the filling the vacuum. So I am actually a little confused by where Mr. Stockton and Ms. Dynan are on your fiscal projection. So because you focused a lot on non-defense, right? So if we look at the overall fiscal impact, or whatever you want to call it, at the federal level, is that a plus or a minus? I thought from what Karen implied that it's likely to be a minus, at least on the discretionary side. But maybe there on the non-discretionary side there'll be enough plus so that there's an overall whatever it is plus. And then the second question, a related question, is there's always, even though it's small in the United States, there's always the state and local governments, right? I mean, if we were at the OECD, we would want to look at general government. So if you wanted, could you sort of fill in those gaps, if that's not being too something or other?
Why don't I start out, and then Karen could add some critique to my remarks. So the package that I presented, the $180 billion of deficit enhancing fiscal actions, which was obviously tilted towards corporate tax cuts and some spending increases, has a smaller effect on GDP in the time frame that I'm showing here. Just holding monetary policy constant, that package produces a plus of maybe 3/4 of a percentage point on the level of GDP by the end of 2019. Now, as both Karen and I have noted, that's not going to take place in a vacuum. There is going to be a Federal Reserve response to that. And I think, while I do think the Fed will wait and therefore it results in some overshooting, the Fed offset could be another 1/4 percentage point, at least in this time frame, so that we're talking about a net stimulus, sort of the net addition that I made to my forecast in response to this fiscal package being maybe 1/2 percentage point. So that's roughly speaking. And Karen's right that the sum of the increase that I am projecting in defense and non-defense discretionary spending is just needed to sort of keep pace with the overall size of the economy. Then on the state and local side, I think we're going to see a small positive contribution from state and local fiscal policy at this point. We actually got some bigger contributions from state and local government as their fiscal conditions began to improve. That's mostly behind us now.
Thank you.
Yeah, so I mean, I think in broad terms, I'm largely in agreement with Dave. My comment, my comment about mild contractionary was because I personally think it's likely that we'll see a rise in spending in fiscal year 2018, just not enough to kind of hold the ratio of non-defense discretionary spending, total discretionary spending to GDP constant. But that's really just small potatoes. I think, kind of broadly speaking, I think Dave has a very reasonable package in there. I'm a little more of a skeptic on infrastructure, just because what we've heard has been all over the map. And at least for a while, it seemed to be very much on the back burner. I guess it's been moved up to the kind of front burner. More recently, we've heard a few remarks in that direction, but that's the one place where I'm a little more doubtful than Dave.
Unless Joe wants to add anything, here, please.
Bill Lane, and I think I fall in the category of guest of the Peterson Institute. A question regarding the border adjustment tax. I think between the VAT and any kind of consumption tax, which is border adjusted on exports, I think that's pretty clear and what have you as far as being consistent with our WTO obligations. But when you get to the border adjustment tax, much less so. When you figure out the impact on the economy, and this is open to all three, whoever wants to jump in, the U.S. is going to have to either give massive amounts of compensation in the way of whatever we do with a border adjusted tax, or we're going to get into just a good old-fashioned trade war. Have you tried to figure out what the implications of that would be on the U.S. growth rates, and sort of extrapolate that out? And do you think people truly understand the difference between a VAT and a border adjustment tax as far as how that affects trade?
Before my colleagues reply, I should pick up on Karen's earlier quite justified but welcome advertisement. As some of you are aware, we've had a multi-author effort here at the Peterson Institute working on just these issues. Joe co-authored a piece with Carolyn Freund on the exchange rate impact. Carolyn Freund and Chad Bown are editing with me a collection of essays by the Institute on this. And of course, we have prior work by Gary Huffbauer, Marcus Nolan, and Sharon Robinson on what the cost of a trade war would be. So that is all out there. But anyway, the bottom line is, from the consensus range of those studies is that this definitely is not simply a VAT. There certainly is enough there to justify, in legal terms, contestation and retaliation, even if it's not 100% sure that it's justified. That the exchange rate impact, and this is particularly where I think Joe and Carolyn's work is very important, the exchange rate impact, we're talking about a 25%, assuming the current proposal. If there was a full exchange rate offset, it would be a 25% real change in the value of the world's reserve currency. This has potentially very large implications for emerging markets, for workers in the US, for, as Karen mentioned, valuation of assets abroad. Suddenly, the Chinese holdings of US treasuries, all those exchange rate manipulators that Joe and Fred Bergston have pointed out through the years, suddenly get a huge windfall that is not taxed. It's a very big deal. So I'm sorry to scoop Joe, but just to say we have Joe and Carolyn's working papers already on the website. We have a number of works on this. Joe, is there anything else you'd like to pick up?
Two small points, Adam. Completely agree with everything Adam said. Just note, I do believe the experts who say this would be illegal as written in the House proposal under WTO law, but as the economists behind the proposal say, well, it could be restructured as a plain vanilla VAT and a reduction in payroll taxes or even a wage subsidy and effectively be the same thing. So if they wanted to, they could do it without sparking a trade war. But absolutely, this is an enormous shift. We have, in our study with study with Caroline, we never saw a case in which a country changed a border-adjusted tax by anything close to what this would do. And this, given that it's tied so closely to the labor cost deduction, which is different from a VAT, that would tend to make the adjustment pressures much weaker and slower. And so if the exchange market didn't do all your work quickly for you, there'd be lots of transition effects.
Transition effects is economics for, in practice, it would be messy. Yeah, no. This is why you're half a guest at the Institute, and we like having you around. Turning to the back mic, please, and then the lady there, Jessica.
Jacob Kierkegaard from the Peterson Institute. A question for Dave and probably also Karen. It goes to this issue of participation. And I don't remember which, I think it was you, Dave, who had a slide that said something like, well, women are no longer storming into the labor force and that we've seen a firming in participation. I gotta say, that's pretty good spin, right? I mean, we're talking about a historic low participation rate, and echoing Adam's point about some international perspective on some of these US data, participation rates in other advanced economies that are under much stronger demographic pressures and have endured longer recessions, have lower growth rates, are actually at near historical, if you're looking at the EU, the Euro area, and Japan, at historical heights, not 30-year lows. And the projections that you are all forecasting basically seems to, one, accept that, or at least forecast that, or at least implicitly saying, well, nothing that macro is going to do is going to change that. Isn't that a monumental failure?
Well, failing not of our friends, but
No,
failing of the U.S. economy.
But I mean, in terms of U.S. macro policy.
Right. Thank you, Jacob. Just being clear.
So I'll start. Karen, I'm sure, has got some things to add to that. Absolutely. The point I was making in my slide was that we have actually seen some benefit from running a hot labor market in terms of stemming, at least for a time, the downtrend in the labor force participation. But if my forecast would be, once we get past later this year, we're going to be back on a downtrend of roughly 0.2 of a percentage point a year decline in labor force participation, owing to just the plain old demographic factors that are in play. And so that is, I think, you're correct to frame that as a major policy problem. I think Karen was in some sense alluding to that. We need to go to the areas where we can boost structural growth in the United States. I know we've often talked, structural adjustment is like something that's a little bit like Adam's talk about how we talk about other people's fiscal policy. We are always talking about other countries' structural adjustment problems, but we've got some very serious ones, and I would put labor force participation right at the top of that list.
I'm glad you brought this issue up. So first of all, the international evidence is so striking. If you look at prime age female labor force participation, when you look at a graph that goes back to, say, 1990, there we were kind of marching up with all of the other countries. In 2000, the female prime age labor force participation rate kind of flattened, then it kind of came down during the recession. Those other countries, I mean, some people would say, oh, that's just a natural topping out. But the striking thing is the other countries, they just kept marching up with their female labor force participation rates. So it's just completely striking evidence, as Dave said, or as I said, getting labor force participation up is an essential ingredient towards raising long-term growth. I should say it's not just women, it's prime age men as well. There's been a steady decline in prime age male labor force participation. It's come down something like 10 percentage points over the last 50, 60 years. And this is something that policy could affect. So people talk about paid leave, people talk about incentives you could have in the tax system to draw more women and men into the labor force. And I think the final thing I'd say is not just policy specifically targeted at labor force participation. I think some of the decline, particularly for men, is a story about wages stagnating. So any policy, for example, providing greater access to education that would raise wages in the lower part of the income distribution would probably raise labor force participation.
Just two quick notes. As some of you have seen, our colleague Jason Furman published a pretty notable blog, and then in Vox, I believe it was, talking about the limits to growth, and very much in the spirit of what Karen and Dave have been talking about, and very much resonating, I think, with Joe's chart about the declining terminal rate of the Fed hike, which is another way of saying they expect the natural rate of interest in the U.S. economy is lower, which reflects these factors. I would also just throw in, I mean, Jacob, that was also, of course, a setup, and we know you not planned setup. We know you feel strongly about this. Karen mentioned the kinds of policies. It's important to remember that Japan, which we, myself included, spent literally decades screaming at, sexism is killing your economy. You should do something about it. Well, they have. And the rise in female labor force participation over the last 3 years has been more than enough to offset their demographic decline and projects to continue to offset it for another 3 years. Now, that doesn't solve their problem, but it shows it can be done. And so, as Dave said, it's kind of nice to occasionally take a perspective outside the U.S., as you encouraged us to do, Jacob. Our last question is the lady at this table, please.
Hi, Arbor Johnson with Itochu. I wanted to push a little more on the potential negative risks of trade protectionism, which you've touched on a little bit with the border adjustment tax, but also the immigration/travel ban and the chilling effects that may have on tourism, foreign students coming to the U.S., the technology economy.
Karen, you had that in your slide, so you're stuck.
Yeah, so as I said in my slide, for sure, the kind of cutting back on immigration is just in terms of the basics of the fact that we need to get our workforce growth rate to pick up. And immigrants, by the way, immigration, at least over the next decade, it will account for most of the growth in our workforce. So any policy that's kind of walking back immigration is going to be harmful in that direct sense. And I should say also immigrants are disproportionately likely to have patents. So there's some view that, or there's some evidence that immigrants having more immigration will promote productivity growth, which is another part of long-term growth. You talked about a bunch of individual sort of special cases of or indirect effects in terms of immigration policy. What about tourism? I agree. I have not quantified those effects, and I don't know if Dave's done any thinking about the effects of a trade war on how that would alter your forecast.
Well, the Institute did put out a piece last September looking at what, in fact, implementing Trump's then proposed trade effects would be. And you can get a very big negative effect on U.S. GDP. through a significant disruption of trade. So I think that is one of the things that, as I said, this, the potential for a demonstration of general governmental incompetence. Trade policy is an area that could really shake business and household, but especially business confidence in a way that could have a nonlinear negative effect. The other kinds of things you were talking about, things like making the U.S. a less attractive place for people to come to school or for tourism, those are negatives too. I see those sort of as things where like the termites eating away at the foundation of the house. I don't think you'll ever point to a quarter or something where you say, gee, we can really see that effect sharply, but it just undermines, again, the longer-term growth potential of the U.S. economy by making it a less attractive, less competitive place for people to locate businesses or to move to work. So I think we have the potential to go just in the opposite direction of what we need to. As Karen was pointing out, we need to be boosting sort of the supply side of the economy, and much of what we seem to be focused on right now seems like it was much more likely to undermine than to build that.
Thank you very much. I think it's been a terrific session. Please join me in thanking my colleagues. Just a couple programming notes. 24 hours, or rather 22 and a half hours from now, we will have another event here, highly relevant, talking about the effect of tax changes on productivity. Can tax reform reduce resource misallocation? Vidor Gaspar of the International Monetary Fund will be presenting their new study, and the aforementioned Jason Furman from the Institute, as well as Mihir Desai of Harvard Business School, will be discussing that. And turning back, that's a cross-national study, and turning back more internationally as we come into the Fund Bank spring meetings next week, we will have an important talk on the future of Europe by EU Commissioner Pierre Moscovici and our beloved colleague Arvind Subramanian, currently on leave from the Institute as economic advisor to Prime Minister Modi in India, will explain a little bit more than Dave did, that line that says India is growing pretty well. But for now, this meeting is adjourned. Thank you for joining us.
Absolutely. Yeah, it was nice.